Morning, everybody. Thanks very much for coming. I'm just going to talk a little bit about the industry that we all love, gold mining, and try and give a little bit of an overview of how we go about picking gold stocks in our fund and what some of the principles are behind the stock selection that we do. So, a little history. I think a lot of us are sometimes surprised that generalist investors hate our sector, can't be bothered to get involved. And that's a little chart which shows probably why. So that's the period from 2011 to 2015. Which was a good period in equity markets in general. The S&P over that period was up about 70%. Gold was down 40% during that period. And gold miners, that's the GDX that you can see there, that was down 80%. So, and I think that generalist investors who've got a reasonable memory, at that point they just said, right, never again. We don't want to get involved in this sector again. And you have to bear in mind that the gold mining sector is really small in a global context, right? So the market cap of all the gold miners in the world is about $380 billion US. So that's about a fifth of the market capital of Apple, all the gold miners in the world, right? And gold miners are not really in anybody's benchmark. There's Newmont in the S&P 500, but it's one of the smallest constituents. There's no gold miners in the stock 600. There's no gold miners in the Nikkei. There's no gold miners in the MSCI World. So for a lot of investors, it's a troublesome and tricky sector which they don't need to be invested in. So let's just have a think about what the difficulties are of gold mining. And I think that first chart there, which shows the average mine life of different commodities, it is probably the heart of the problem and the thing which gold miners need to solve on a day-to-day basis or need to manage on a day-to-day basis, is that gold mines are small and they have very short lives. And, that makes sense. I mean, that's why gold is rare. That's why it's valuable. There's not much of it about, and it tends to be found in small quantities. And the problem with that is that you can see there the average mine life of a copper mine, for instance, in the world is about 35 years. The average mine life of a gold mine is 7. If you're a copper miner, you make your initial capex, and then you've got 3 or 4 economic cycles in which to get a return on the capital that you've invested. Whereas for gold miners, you may not even have a whole cycle to get your money back. And of course, the CEOs of gold mining companies are permanently faced with the challenge of replacing reserves. And that's expensive, and you can do it through exploration, you can do it through M&A, you can do it through building your own new mines, and all of those solutions have their challenges, and they're all capital intensive. And the problem with that is that obviously you need to find the money from somewhere to constantly replace your reserves. And when do you have the most money to invest? Well, it's when the gold price is high. And that has meant that traditionally the sector has been very pro-cyclical in terms of its capital allocation. And the second chart just shows Barrick's annual capex versus the gold price. And I'm not particularly picking on Barrick, but you can see how investment is correlated with the gold price. And in 2011, when the gold price was at 2,000, Barrick made the maximum of investments. they not only invested all their cash flow, but they took on some debt as well. And then when the gold price fell to 1,050 in 2015, and assets were very cheap, well, at that stage, they weren't able to make any investments. So, and in fact, they had to sell some stuff because they had some debt, and the bankers were getting upset with them. So, you know, in the gold mining industry, we've had this history of investing a maximum at the top when they had the money to invest, and at the bottom, when things are cheap, they haven't been able to invest. So you've got this whole very pro-cyclical behavior, which tends to destroy a lot of value. You know, if you buy most of your assets at the top and you're actually selling them at the bottom, you tend not to create much value for shareholders. So I think after the problems that the industry had in 2015, 2016, a lot of management changes, and I think that the management of the industry realized that they couldn't carry on like this, right? You couldn't carry on serially destroying value for shareholders. And these are a couple of slides from a Newmont presentation of a couple of years ago. And I think it's interesting because I think that this marked a big change in what the industry is doing. So the first chart shows Newmont's kind of growth ambitions in terms of ounces produced per annum. And you can see it's pretty flat. They pretty much abandoned any ambition to grow production significantly. And on the second slide, that's what they want to do with costs. So you can see that they're working hard to control costs and get them down. And I think this is a kind of change of philosophy, because in the past, gold miners have been very ambitious in terms of growing production. Here's the leader in the sector saying, we're just going to maintain production at a stable level. We're going to work on reducing the costs, and any profits that we make from that initiative, plus any extra bonus that we get if the gold price happens to go up, we're going to start returning it to shareholders, either through increased dividends or through share buybacks. And I think when the market saw this, particularly generalists, they were very skeptical. They said, well, you know, it's all very well to say that, but if the gold price goes up again, you know, these guys, they're going to be out there doing the same crazy stuff that they did in the last cycle. But that's not really what's happened. And you probably can't see this slide, but I mean, that just shows the quarterly dividend record of Newmont. So, you know, they were paying 14 cents a share at the beginning of 2019, and today they're paying 55 cents a share. So you can see, you know, very strong dividend growth. The gold price, you know, has gone up versus where it was in 2018, beginning of 2019, and they've actually done what they said they'd do. So they are, you know, returning cash to shareholders, and on top of that, they're buying back shares. And that strikes me as a much more sustainable business model for an industry where there isn't a great deal of growth at the moment. So how can they do this? Well, this is a chart which shows the black line is the gold price, and the bars at the bottom are the industry's all-in sustaining cost. And what you can see in the past is that there's been very, very poor cost discipline in this industry, and as the gold price has gone up, costs have gone up. You know, if you look at that period, 2002 to 2011, sure, the gold price went up a lot, but so did costs. And what's happened since 2015 is actually the industry's controlled costs pretty well. And, you know, there's been some inflationary pressures recently, but you can see that the difference between the cost and the price of gold is margin, and the margin for gold miners has never been as wide as it is now, and that gives them the ability to continue to invest to replace reserves and to remunerate shareholders. And you know, the dividend yield on the sector, on the producing sector now, is around about 3%. And that's the first time in living memory that we've had a yield on the gold mining sector which is above the yield of the S&P 500. So I think there's been a real sea change in the industry, and it's become a much more shareholder-friendly proposition. So has the market saluted this change? Well, not at all. Here's 4 charts of different valuation metrics. I'm not going to go through it in any detail, but you can see that actually the sector's never been so cheap. So there's been no re-rating, quite the contrary on some metrics. So we now have a sector today which is really deep value in terms of the valuation relative to the market and relative to the industry's own history. So you've got an industry which is run on a much more healthy basis and which is as cheap as it's ever been. And I really do think that there's an opportunity for investors here. I won't go through that. So the other thing that I think we have to be really careful of is how companies finance their growth, and are they financing it from internally generated resources, or are they going back to shareholders? So this is a chart of First Majestic. The white line is the share price, the blue line is the silver price, and the orange line is the number of shares in issue. And this is something which, the precious metals industry in general has been very bad at, is controlling the number of shares in issue, and that's something which ends up weighing on returns. And you can see there the tremendous volatility in the First Majestic share price. It's often a fantastic trade in terms of getting leverage to the moves in the silver price in the short term. But over the long term, and there we're talking, since the 2015 lows up to today, the stock has returned pretty much the silver price, right? So it hasn't really given you. It's had the same performance as silver, but with much more volatility. And I think part of the problem of many of these larger silver and gold miners is just they're constantly issuing new shares to finance growth ambitions, and that dilutes shareholder returns very significantly over time. So I'm just going to talk a little bit about how we pick stocks in our fund. This chart shows the best and worst performing stocks in the GDX over the past 12 months. It's a bit of a busy chart, but I think the point is just to show the kind of dispersion of returns that we have in the gold mining sector. So the one on the top, which is Perseus, Australian-listed gold miner with assets in West Africa, over the past 12 months has returned 80%. And the worst one is Kerr Mining, which has returned minus 63%. So, and you've got a number of good and bad returns in between. And that doesn't happen in many sectors in the market. So you've got 150% dispersion in performance within the 50 stocks in the GDX. And all these guys are doing the same thing. They're all mining for precious metals. And I think the takeaway from that is that stock selection is kind of really important, right? And I've never seen this kind of, I was a generalist investor for 25 years, and I've never seen this kind of price dispersion in the same sector. And this is not just a recent phenomenon. You go back every year, there's always a huge dispersion in returns between the different gold miners. And so it's an ideal hunting ground for stock pickers. You really can, over time, outperform the GDX, which is our benchmark. If you're disciplined in your stock picking and you avoid some of the serial value destroyers in the sector. So we have a kind of 6-step approach to picking stocks. And I'll just run through them quickly. So the first thing we look at is costs, really, to try and hedge ourselves against volatility in the gold price. And there's a feeling in the industry that when you're bullish on gold, and most of us are bullish on gold most of the time, is that you want to buy the high-cost producers because they're the ones that give you the most leverage to the gold price. We kind of take the opposite approach, and we try and buy the lowest cost producers. So we like to buy companies which have costs in the bottom quartile of the industry cost curve. And that's a conservative approach. And it does mean that if we're all wrong about the gold price, and we often are, that our companies are running on a sound basis, that they can continue to pay dividends, and that they're not going to go bust. And that's as I say, it's a conservative approach. It's not a foot on the accelerator kind of approach. But I think it's something which over time, because the gold price is cyclical, it is a good and sensible way of investing, particularly when you're investing other people's money. The second thing that we look at is balance sheet. I think debt and mining don't go together very well. It's a hugely operationally leveraged business with relatively fixed costs and very variable revenues. There's a place for debt in financing mine construction, obviously, but we tend to avoid companies which, as part of their balance sheet structure, philosophically always fund the business with part of debt. And we saw that in 2015 with the companies that had taken on debt at the top of the cycle. It nearly destroyed them, and a lot of companies were very close to bankruptcy. So we look for companies which structurally and philosophically have little or no debt. And indeed, the industry's done a very good job of paying down debt. There are very few of the large miners which do still have debt. The third one is a political risk, and this is not something which we are completely blinkered about, but you can't get away from the fact that there is a lot of gold in risky jurisdictions, and you don't want to have all your eggs in a risky jurisdictional basket. So what we try and do is have about 80% of our exposure in tier 1 jurisdictions, so Australia, Canada, and the US. And then we have 20% of the fund in riskier jurisdictions. And indeed, some of those investments in risky jurisdictions have been some of the ones which have provided the best returns in the fund. And that's what you would expect, because when you take more risk, you do expect more reward. But our political risk filters, for instance, meant that we had no investments in Russian gold miners. And we still have no investments in Russia or China. And that's kept us out of trouble. Fourth one is ESG. Our gold mining fund does have the ESG label of the French state, and it also has the Lux flag ESG label. But this has always been part of our process since we started investing in the industry. And I think it's just common sense, particularly on a social front, but also on an environmental front. If you start spilling cyanide into the water table, well, your mine's going to get shut down. So you better make sure that you do those kind of things properly. And if you have poor relations with the community where your mine is, all kinds of bad stuff's going to happen. And there are many examples of poor community relations which have led to strikes, to blockades, and none of that stuff is good for shareholders. So that's a key pillar, and it's not a mechanical kind of approach that we have. We're really looking at what's happening on the ground and how people are managing their environmental exposure on a day-to-day basis. The next one is mine life. I said that the key problem of the industry is short mine lives. So obviously one of the things you can do is look for mining companies which have longer than average mine lives, and that's certainly a big consideration when we're selecting our core positions. And the last one is management. And, I think this is people from the outside think mining is easy. There's stuff in the ground, you're digging it up. What's so difficult about that? But I think, we all know that actually mining is a very complex cocktail of geology, metallurgy, engineering, logistics, community relations. It's a complex business to manage, and the skills and the track record of management make the difference. And I think it's one of the big factors in explaining the big dispersion of performance that we have within the stocks in our sector. So that's just quickly our little fund and its track record. It's been going for just about 3 years now. We apply these principles I've been talking about to stock selection. The fund's up about 105% versus the GDX, which is up 70, the GDXJ up 55, and physical gold up around about 50. So I think our methodology does work, and it works on a fairly consistent basis. So just in conclusion, I think gold is a tricky industry. It's not easy to create value. I think gold's gone through a bit of a correction, obviously, really since the high in August 2020. But I think we don't manage the fund with a kind of bullish or bearish bias on the gold price, but I'm pretty positive about the outlook for gold. And I think all the things that you all know about, very low interest rates, massive monetary creation, and an inflationary cycle, which is just starting to gather speed. I think the fundamentals are pretty good for gold. And I think gold mining stocks just remain exceptionally good value. We've never seen such low valuations. It's not as if the gold price is at an all-time low. Gold miners are making tremendous margins at the moment. And I'm really feeling optimistic about the next couple of years for the industry. I'm going to stop there. If you've got any questions, I'm happy to take them now or to chat to you in any of the coffee breaks. Yeah.
There is a theory that the gold miners lead the physical gold price.
Yeah.
You can confirm that?
Yeah, I guess that that can be right over relatively short periods, right? And I think that is often a function of the relative liquidity in the different so when investors in general start to feel bullish about gold or gold miners, the gold miners are much more responsive because physical gold is a huge and liquid market. You can buy billions and billions of dollars of this stuff without moving the price. Not so for gold miners. So, if you go in and you buy, you want to buy, if you want to buy $50 million worth of the GDX, you're going to move the price quite a bit. Yeah. You buy $50 million of physical gold, you're done, right? On the touch. So, I think, observationally, that's absolutely right. The gold miners kind of indicate where sentiment is going. Yeah. Yes.
Do you think that the change from the central bank and the BIS from unallocated to fully allocated gold will have a material effect going forward, or do you think that's through now?
I think, I don't know. I'm not a specialist on the physical gold market. It's a story that's been around for a while, so I would guess that it's pretty much discounted now. I think probably what's not discounted is actually what's happened with the sanctions on Russia, because I think that must be a real wake-up call for central banks, particularly for non-aligned countries. You realise that actually, if you have your reserves in bonds issued by other countries, well, they're not really reserves, right? Because if you get into an argument with that other country, they just cross your assets off the ledger. And so Russia's, they've already massively reduced their investment in T-bonds, but they still had some, and they had a lot of bonds, right? And those are not monetizable now. Whereas physical gold is, and you can sell it to anybody at any time in any currency you want. And I think for China, for India, for non-aligned nations, they must be thinking hard about how they have their reserves invested. And I think over the next 2 or 3 years, it's not a short-term catalyst, but over the next 2 or 3 years, you're going to see a continuation of what we've seen over the past 10 years, which is a big net purchases by emerging market central banks of gold. I think that's a tendency that's going to accelerate over the next 2 or 3 years. Yeah.
Just in terms of the general market, what's your view? I think we're all probably expecting a general market correction. But what's your view in respect of money returning to value investing, like it already seems to be doing in terms?
Oh,
of
yeah.
And how that might impact the generalist interest in our sector?
Yeah. I think you can already see it in the general mining sector. So, it's one of the few sectors that's up this year. I think generalist investors, they tend to put mining in one big bucket, and so you've seen pretty good performances from stocks like Glencore and BHP and Rio, certainly relative to the market. So I think people are beginning to wake up to that, and I think you can see it also in the performance since the beginning of the year in the GDX. So one of the best performers has been Newmont, because it's the biggest and the most liquid, and it's the only one that US institutions can buy, right? Because it is a US incorporated company. It's in the S&P 500, and it's been really uncannily strong, actually. On some days when the GDX is off a couple of percent, it's just sitting there and it's up 0.1, right? So I think that there really is some interest coming towards the mining sector, and I think part of that is exactly this switch away from highly valued, unprofitable technology stocks into companies which have got no debt, and massive free cash flow yields and attractive dividend yields. Yeah, so I think that's definitely underway. Good. Okay, guys. Well, I'm going to stop here and hand over to Adriatic. And thanks very much for your attention, and happy to chat to anybody in the